All right. Good morning, good afternoon, good evening, everyone. Thanks so much for joining the session today. My name is Peter Zetterly. I work for Seagap, and we've been studying the evolution of financial services for many years. What we're going to be talking about today represents a major shift that is underway in banking, and that is the unbundling and embedding of financial services. And we actually have a new publication on that topic out today, which we can get on cgap.org/fintech. So go check that out. I'm going to give you the highlights from that deck in a moment, but I also have with me three illustrious panelists who are very well placed to speak to how banking is changing from different vantage points. I'm really pleased to have with me today Devyani Parmeshwar, who is head of product at M-Pesa, the world's biggest mobile money player. Chai Puisan, who's director of public affairs and policy at Grab, the biggest ride-hailing platform and super app in Southeast Asia. And Phil Goldfeder, who is Senior Vice President for Global Public Affairs at Cross River, one of the leading providers of banking as a service, which we're going to be talking more about shortly. We're going to run this pretty much like a traditional panel discussion. I'll kick us off by talking about why and how banking is changing, what we mean by unbundling and embedded finance, why that matters for financial inclusion. Then I'm going to invite Puisan, Phil, and Devyani to tell us each about what their companies are doing in this regard. I'm going to then pose a few questions to them about the future, how they see the future of the space and of their companies, and then we'll take some questions from the audience. If you want to pose questions, please put them in the Q&A part of the interface. Please also use that to upvote other people's questions that you think are important, because in the last part of the session, I'm going to pose the highest ranked questions to the panel. And with that, I think we have a lot to talk about today, so let's just dive right in. The backdrop for this conversation is the rise of various digital technologies and the new business models that they enabled. We could talk a lot more about this, but just to briefly mention what they are, it's the ubiquity of smartphones, the rise of cloud computing, API-based architectures, AI and machine learning, as well as software as a service and platform business models. These are forces that have already disrupted multiple industries, from transport to travel to music, to retail commerce. And there's every reason to expect that they're going to reshape the financial industry as well. One way that they're doing that is by dramatically slashing barriers to entry in financial services, because the cost of launching a tech startup has fallen dramatically from $5 million at the turn of the century to $5,000 just 10 years later. And that unleashed a wave of innovators creating startups, just as global funding for fintech just skyrocketed to a point where fintech now represents a quarter of all venture capital deals worldwide. And that combination of dramatically lower cost and dramatically more funding has meant an explosion of fintech challengers looking to reinvent financial services. And that's had huge implications for financial products on the one hand and financial processes on the other hand. On the product side, every part of what a bank does, every part of what a bank offers consumers is now being challenged by a whole host of fintechs trying to do it better. Whether you look at payments, savings, lending, insurance, investing, in any aspect of banking, there are now dozens of players competing for consumers, and they're laser focused on being the best at that particular product. And that's stressful for banks, but it's great news for consumers, because people used to be relegated to buying whatever their bank happened to be selling. And if some of those happen to be awful products, well, that's too bad. But now people can pick and choose products quite freely from dozens of different providers, and they can assemble their own sort of personal Swiss Army knife of financial solutions that's customized to their particular needs, their preferences, and they can change it anytime that they find something better. I'm sure many of you are doing this yourselves, for instance, by using a number of different payment apps for different use cases, right? So Venmo for this, PayPal for that, TransferWise for remittances, and so forth. So how we consume financial products is really changing quite radically. But what's interesting is that the same thing is happening on the back end of banking and the processes along the value chain. And if we map out a stylized picture of the banking value chain, in the old days, banks largely did all of these things by themselves in-house in these vertically integrated value chains. But today, we're seeing highly specialized B2B fintechs popping up all over the value chain that are creating best-in-class solutions for every single piece in the chain. And that means that banking itself is actually being disassembled into its constituent parts, where financial service providers are increasingly able to swap out the gritty old pieces with shiny new fintech ones that are provided by third parties. Typical example would be to improve your digital onboarding by plugging in a biometric solution from companies like Onfido or Jumio that are now big players in the banking space. But here's the kicker. It's not just banks that can do this. Any company can plug in financial products and processes into their existing digital offering. And that is what we mean by embedded financial services. So what does that actually mean in practice? And what does it have to do with financial inclusion? I'm going to try to answer that in a few different ways. First, by showing you a very short video.
Technology is changing banking at every level, potentially transforming how low-income people and businesses engage with the financial system. Like Farida. Farida runs a small clothing business in Jakarta, Indonesia. She uses a social media app to market her products. She also has a mobile money account that she uses to receive payments, pay suppliers, and buy airtime. However, she can't get a loan to expand her business or sign up for a savings account to pay for her daughter's schooling. Many financial services are just too expensive and hard to access. Farida's situation isn't unique. Hundreds of millions of people worldwide live with similar circumstances every day. That may be about to change. Historically, even people with a bank account tended to only use a single provider that offered them a limited menu of its own products. Thanks to new technologies, there has been an explosion in fintechs that specialize in offering better versions of many services. As a result, people can choose from a range of providers and assemble a suite of products to meet their needs. This unbundling of financial services is putting the custom back in customer. But new technology isn't just giving people more options, it's also changing how financial services are made. Banks used to do everything themselves. Today, they can stitch together the best solutions from an array of fintechs that are focused on solving a specific problem better than anybody else. And it isn't just fintech solutions can be embedded into any company and reassembled to meet the needs of customers. Thanks to all these advances, Farida can buy more fabric with working capital from a fintech. She can also save for her daughter's education with the savings account she obtained through her mobile wallet. The payments and delivery services embedded in her social media app can help her grow sales. And she can upgrade her sewing machine with asset financing secured against her digital income. These advances create new risks that need to be managed by regulators, businesses, and consumers alike. But they can also result in banking that offers lower costs, greater access, better products, and improved experiences for customers, including low-income customers. Whether these benefits are realized will depend on the choices made by businesses and regulators. To learn more and stay informed, visit CGAP.org/fintech.
I hope that gave you some idea of why we think unbundling and embedding matters for financial inclusion. And it's important to stress that this is not just an hypothesis. These things are happening already. One example is Grab that we're going to hear more about in a moment. Another powerful example, I think, is Stripe, which started out to transform digital payments with a simple API-powered offering. Today, Stripe is embedded in many of the world's biggest companies. You probably used many of these companies. You probably also had no idea that the payments piece of those companies is actually Stripe embedded, because Stripe is not a household name, but it is an absolutely massive company. It's valued at $95 billion. It's used by millions of companies in over 120 countries that embed their solution. And what they embed typically, and what they've been embedding so far, is a payments piece, a seamless end-to-end solution with various features that are completely white label, that clients embed into their own apps and websites via API. But Stripe also does small business lending. If you run a small business using Stripe for payments, you can access working capital directly from them. And if you run a big platform like Lyft or Amazon, you can offer lending to your own customers within your own interface with your branding on it. Stripe also offers bank accounts via API. Same thing. Small businesses that use Stripe for payments can open a bank account seamlessly in Stripe, and big platforms can offer bank accounts to their own clients under their own brand, all API based, all seamlessly embedded. But of course, Stripe isn't holding those accounts or underwriting those loans. They're partnering with banks who take the balance sheet risk. And that, I think, gives you an idea of the power in embedded financial services, because with just a few companies like Uber and Amazon can offer bank accounts and bank lending, well, the scalability and reach are just enormous. But it's not just about scale. These products can also be better than traditional banking products in a few different ways, because firstly, they exist within an economic context and they're designed specifically to fit within that context and solve problems there. They're embedded in that context, so using them is seamless and easy, and they draw on data from that context, which makes low cost and quick risk assessment and processing possible. And while banks are playing a key role in all of this, it's only part of the role that they are used to playing. And so we actually see the market structure itself as becoming more unbundled, perhaps divided into these four broad layers around the balance sheet, the product, the customer relationship, and the physical distribution. Offering banking used to mean that you do all these things and have all these layers in one. But now technology lets us separate them. And once that happens, economic pressures then push things in that direction because different players have different strengths across these layers. Unbundling lets them make different business model choices across the four layers. So many are likely to specialize in areas where they have a competitive advantage and then plug in partners for the rest. And that is fundamentally changing what banking looks like, front end and back, because banking can now look like this. Shopify is one of the world's biggest e-commerce platforms. They have 100 million users. They have 2 million shops across 170 countries. And they now offer Shopify Balance, which is a bank account built right into the platform. You can set it up online in a few minutes. It has no monthly fees, no minimum balance. And this is not an e-money account or a prepaid card. It's an FDIC insured small business bank account branded by Shopify that integrates seamlessly into your Shopify business, making your cash flow, your tax reporting, and so forth easier. So is Shopify now a bank? Well, that depends on your point of view, because if we look at what's going on the back end, Shopify has the customer relationships and the physical distribution piece. But the product enabling all of that is embedded by Stripe. And the accounts are actually held at one of Stripe's partner banks who manage the risk and the regulatory requirements and so forth. So is Shopify a bank? Well, it depends. They certainly don't have a banking license. No regulator would ever call them a bank. But to Shopify customers, chances are they never heard of Stripe or their partner banks. So yeah, Shopify might be bank to them. And we could argue all day about whether Shopify is or isn't a bank now, but that's missing the point, which is that banking is changing very fundamentally and that people are increasingly getting their financial services directly in the digital environments where they're already active. They don't need to go to a branch. They don't need to go to a website of a traditional bank even. The banking products are coming to them, integrated with, tailored to the things that they're already doing. And that is what embedded finance is all about. So this is all very interesting and very cool and all, but is it helping to drive financial inclusion? We think it can, because it can help to cut costs of delivery of financial services through cheaper customer acquisition, distribution, risk assessment. It can help expand access through greater eligibility for products, greater affordability, and a shorter distance, both physically and digitally, between the customer and the product. It can help create a better product and better product fit, making products that are more directly relevant to the context in which they're offered and more tailored to different users in that context. And it can help to create better experiences through simpler and smarter products that are easier to understand and to use. Of course, this all speaks to potential. What businesses choose to do with that potential is up to them. But we feel confident that there are enough incentives for different players to drive scale that once these abilities are available, the market will push in every direction, including downward. Of course, it will also bring new risks. Regulators are going to have their work cut out for them over the next few years. overseeing consumer protection, market conduct, liability, concentration risk, and so forth. Some of that might require entirely new ways of thinking about things and doing things for financial authorities as well. But we think that journey is worth making in return for the potential that embedded finance offers. And we're going to spend the rest of the hour talking about these things with my three guests, who each represent a slightly different facet of this story. Cross River really sits at the top of the stack that I've outlined. They offer what's called banking as a service, which basically means a set of white label banking products that others can embed. So they focus on creating the banking products, on managing the balance sheet risk, managing the regulatory requirements and the compliance that comes with that. But then they let their clients handle the customer relationship, the branding, and the distribution of the products. Very different from traditional banking. Grab and M-Pesa have their real strengths at the bottom of the stack. They have these massive user bases, vast distribution networks of drivers and shops and mobile money agents, and they've seen the need and the opportunity for offering financial services to all of those users. But they typically don't want to be banks themselves. At one point, I thought mobile money operators would all get a banking license, but they haven't, and they won't. They want to partner with banks and build banking products into the digital offering that they already have and that they want to focus on. And that business logic has been there for a long time, but it's only recently the technology and business model innovation has gotten to the point where it's becoming really quite easy to do, and some would argue, therefore, inevitable. And that's why this is such an exciting conversation to have. And we have an outstanding group of people to have that conversation with. So I want to turn now to them. And first, just to say that this has been an extremely short summary of a complex thing. At cgap.org/fintech, you'll find plenty of materials that speaks to this, including a new publication on unbundling that's just out today. So go check that out. But now let's turn over to Phil Goldfeder at Cross River, who's going to tell us a bit more about banking as a service, how that works, and the role it plays in embedded finance. So over to you, Phil.
Thank you so much, Peter, and thank you to Seagap for having us. And most importantly is probably having the conversation about how technology is ultimately creating access to financial services and inclusion. Normally when we do panels like this, a lot of people and many have slides or prepared remarks, but it's so interesting because as I was listening to you speak, Peter, I mean, I'm jotting down notes and sort of thinking about how I want to talk about exactly where Cross River fits in that ecosystem. So I think it's so important. I think one thing you said to me that strikes me is, not a household name, right, as the bank, but powering a lot of the infrastructure that most consumers interact with every single day. And that's where Cross River sits. Cross River historically started in 2008. Today merges the trust and reliability of community banking with innovative offerings of a technology company. When we started in 2008, it was very, very simple. And I think something that will speak to the audience today is there was a financial crisis. There was a de-risking from banks all across the country and internationally from the consumer so given the financial crisis and what they were dealing with, most people would argue it's probably not the best time to start a bank. But I think what Cross River did in 2008 is very telling, and I think really leads to where we are today, is that Cross River leaned into the challenge. We recognized there was a de-risking by most of the banks, but think about what that causes, right? Because we all heard the news about sort of the big financial players and the biggest banks across the country, but what did that actually do to Main Street and the access and the ability for everyday small businesses and everyday consumers to access financial services as banks were stepping away from the ecosystem? And so Cross River was founded in 2008 post-crisis with the idea of providing access to financial services where it didn't exist before. And we're happy to report that it was successful because people were eager to have that relationship, to have that access. And so we also recognized early, before fintech was a thing, right? Before the idea of technology was sexy. Today, you can't open the paper without seeing it. Obviously, you mentioned earlier, 25%, I think, of venture capital now is going into fintech. Today, it's a thing. In 2010, when Cross River started its first relationship with a technology company, and it was a very simple concept. It was a point-of-sale lender at Home Depots across the country. And so it was a company called GreenSky Technologies who had partnered with Home Depot. They wanted to offer point-of-sale lending, and they were looking for banks to partner with them. Two advantages. Number one is Cross River had a clean balance sheet, and was successful because of what we were doing at the time. But number two is that we came in post the new regulatory structure. And so, like most banks that had been around before, community and large banks, we're now struggling to understand what the new regulatory regime looked like, and what they had to do and how they have to operate. And I don't have to tell you, it's like turning a battleship, right? It's sort of, you have to really think about your core technologies and your core regulatory structures, and figure out how to change that. And Cross River sort of had the advantage of, number one, understanding that regulatory structure from day one. Number two, again, interestingly enough, founded in New Jersey, a state chartered FDIC insured bank. We were, the concept of regulatory oversight was not foreign to us. And so we entered the partnership not as a great, let's just open the door to anybody, right? We entered the partnership, number one, truly understanding who our partners were, right? And I think that is key to any relationship, to understand what they're doing and how they're doing it. And number two is regulatory first class, right? The idea that we're not looking for a way around the regulatory structure. It's quite the opposite. A lot of the tech companies that come to work with Cross River are looking for that regulatory structure to ensure that they're not successful just for a few months or a few years, but for really the lifetime of their company, and for a long time. And so that was the beginning. That was where we started, and the evolution has gone on, sort of really rapidly since then. And what's so interesting, you shared a slide earlier with sort of the various different companies that were branching off in different ways. We're proud to power most of them. We talk about whether it's Stripe, a company, Affirm in point of sale lending. The example I give that most people know is that if you were to finance a Peloton through a company called Affirm, you're actually getting a loan from Cross River Bank. And so, again, you talk about the idea of not a household name. I think we're a step removed from the Stripes or the Affirms or the Rocket Loans or the sort of the dozens of other companies that we work with on any given day. But think about what that's doing. At the end of the day, it's providing access, whether it was the small business you talked about in your slide or the consumer who needs their item. I mean, studies have shown that most Americans don't have access to $400, right, in an emergency. And so what happens? Where do they go? Sadly, community banks just don't exist anymore. I mean, we're one time in America, we had 20, 30,000 community banks. Today, we have less than 5,000. But let's take it a step farther. Why is that, right? And without going into the cliche of what Netflix did to Blockbuster or what Amazon has done to brick and mortar, at the end of the day, consumers are looking for access in a way that they want to access it. And so you have your traditional consumer, but today, think about the gig economy and how those folks who are driving for Lyft, who are working in the gig economy, want to access their money. I mean, you think about the traditional way in which a driver accesses his finances. There was once a time where he has to wait for his paycheck, right? It was completely arbitrary. We give paychecks twice a week, right? And then you got to get your paycheck. You got to go to your bank. You got to deposit it, and then there's only a certain amount of time until that money is accessible. Today, through banks like Cross River, working with companies like Stripe, working with Lyft drivers, that driver is able to access the money he earned in near real time. Think about what that means for that driver, right? And so we talk about access to financial services. That driver, instead of now having to go and take out a loan to go get gas because he's not getting his actual pay for another week or 2 weeks, he can actually push a button on his phone and go straight to the gas station and pay for it. And so, when you talk about access to capital and financial inclusion, that's what fintech is doing. And there's some creative partnerships that we do, obviously, with technology companies. And the idea is very, very simple, that we're providing the safety and the security. Interestingly enough, all of these tech companies, Peter, you mentioned, sort of can plug into the banking system. But ultimately, that requires a bank to sort of maintain the integrity of the system. For Cross River, we take that part of our partnership and that part of our relationship very, very seriously. We're overly transparent. You talked about the challenge for regulators, right? How do you monitor this situation? Well, that's what banks have been doing for a long time, right? Our goal is to protect the integrity of the financial system, to ensure that consumers are protected. And that is why, we talk about our tagline, right? The trust and reliability of a community bank combined with the innovative offerings of a technology company. And so from where we started in 2008 to where we are in 2021, it wasn't obviously about just being a bank. It was about meeting the end consumer where they are, but how do you actually do that? You do that by meeting the technology company where they are, right? There's still, major banks all across the country, and thankfully, some of the bigger banks are starting to recognize that technology and fintech is here to stay and is actually solving for a problem. But it's exciting that we're able to work with these technologies and build our own technology. And I want to be clear about that. Cross River didn't sit back and wait. We built our own technology because, as we talked about as well, Stripe used to be in the payments business. Rocket Loans used to be in the lending business. Affirm used to be in the lending business. Today, what we talk about embedded finance, banking as a service, the verticals are getting blurred more and more each day. So whereas Stripe was once a payments company, today they're a financial services, sort of a wider financial service company offering access to capital. Similar with Affirm. Affirm was a point of sale lender. Today, they're offering savings account, again, powered by Cross River. And so we're very, very excited. And when we, sort of full circle and coming back to talk about, inclusion, most people that don't have access to a bank account, studies show, still have access to a cell phone. We've been in talks, and the talk of expanding access to cell service, expanding access to the internet. We've been working and talking with Verizon about the expansion of 5G, but not just what that means for communication, what that is going to mean for financial inclusion, because today most people are utilizing their cell phone for most of what they do in their lives, but for sure, but absolutely for financial services. And I'll end with just a really good demonstrable example. And I think for those of you in the U.S., there was recently, obviously, we're all still going through somewhat of a pandemic, but through the pandemic, the U.S. government introduced a program called the Paycheck Protection Program. And the idea was that traditional financial institutions would offer forgivable loans to small businesses in need. And the idea was to reach the smallest businesses who needed access to that funding the most. Cross River, with sort of the chops of a traditional bank, but also access to its own proprietary technology and all these relationships that we have with technology company, we opened our own application for that program. And through 2 rounds of that program, we made more loans than nearly every other bank in the country. And to put that in context, number 1 was Bank of America. Number 2 was Cross River. Number 3 was Chase. And so to give you a sense of what that means, we served small businesses who need it most. And how did we do that? We democratized the system. It didn't matter who you were. It didn't matter where you came from. It didn't matter how big a loan you wanted. If you needed access to capital, we created a technology system that didn't discriminate, that made sure that we maintained the safety and reliability you expect when you're doing your banking services, but we made it accessible. And sort of that propelled us to the top of the Paycheck Protection Program ecosystem. But for Cross River, it was just another example of what we've been doing for so many years. So Peter, again, thank you so much. I'm excited to continue this conversation and answer some questions later.
Thanks so much, Phil. I think that gives people a good sense of where you're coming at it from. And I think that idea of letting go of the customer relationships is just unthinkable to most banks. But as you demonstrated, it can open powerful new partnership opportunities to really drive scale. And now the other side of that opportunity are the mobile money providers who have built massive user bases. There are now 1.2 billion mobile money accounts, according to the GSMA. And mobile money providers were initially focused on payments, but all the big ones have started to broaden the range of financial services they offer, and they're all doing that in partnership with third-party FSPs. And to me, personally, that is one of the absolute biggest opportunities in financial inclusion. So I'm really excited to hear now from Devyani Parameshwar, who's head of product at M-Pesa, to hear how the world's leading mobile money provider is evolving on financial services.
Thanks, Peter, and thanks to the organizers for having M-Pesa here. So I'm going to quickly start with just telling you a little bit about where M-Pesa is today, where we are, and then what we're actually doing in this space. As Peter mentioned, we started out with partnerships, and that's evolved a little bit as the space has evolved in terms of the unbundling. So let me show you what that looks like in our world today. So very quickly, my slides should be showing in a minute. Yeah. So I don't want to presume that you know where we operate and who we are. So as Peter said, we believe we're the original fintech in Africa. We're the first mobile money provider to launch, and that was back in 2007. We're now in 7 countries and soon to be launching in the next sort of 12 months in Ethiopia, which we're very excited about. And we've got about 50 million active customers, so monthly active users in these markets. We started out with this sort of send money home proposition, so a domestic remittance idea. So someone living in the city needing to send money back to their family at home, and the ability to use mobile money using a network of agents. We've got about close to 600,000 agents across our markets. These are small shops. They could be barbers, butchers, bakers, restaurants, etc. That in addition to running their regular business, they also run an agency for M-Pesa, which means they enable the sort of bridge between the cash and digital economies, so people can top up their accounts and cash out, right? To put maybe the sort of scale in context, in terms of revenue, we did about $1.2 billion in the last 2 years, about 15 billion transactions in the last year. That's very close to what PayPal's monthly volume is in terms of transactions. So really high volume, kind of low value transactions is what this is all about. And today, as Peter was saying, we run a whole suite of, or we offer a whole suite of financial services to our customers, both individual customers, the 50 million users, as well as the businesses. So that's about close to 1 million micro, small, medium enterprises between our agent network and our merchant network, as well as a number of developers and other partners that we work with. And so that goes from domestic remittances, where we started, but also international remittances, payments, primarily business payments, so that's in-store, online, as well as sort of semi-offline, so B2B and B2C type payments, and financial services, which is primarily credit for the last many years, but also increasingly more in the sort of micro savings, micro wealth management, and micro insurance spaces. So just maybe focusing a little bit on credit and what this unbundling has really meant for us. So we launched our first credit products in just about 8 years ago now. And at the time, this was untested, right? Partnering with the bank to launch credit products for effectively unbanked customers, and in some instances underbanked, but for the most part unbanked customers. We didn't really know how that was going to go. Sitting here in 2021, this all seems very obvious, but let me tell you sort of what we learned, and therefore where that's taken us. So the first thing that we learned was that our data is actually predictive, right? And it seems really obvious now. At the time, it wasn't clear that we would find enough banks to underwrite this portfolio, and that the NPLs would be reasonable. They're actually a fraction of the average in the markets that we operate in. And so that was the first thing that we said, okay, that this is now something we can build on. The second sort of key learning was really around customer demand. So demand has been tremendous. It's a vastly underserved market, but what we realize is that our customers really appreciate the fact that this is real time, that it's personalized. It's not, for most of our customers who have had access to relatively formal credit in the past, it's been microfinance agencies or SACCOs, where the amount you can borrow tends to be a standard amount that you can kind of graduate in time. So this allows them to get the amount that they want within their credit limit. And the biggest surprise, I think, for us at the time was really that what they valued most was the privacy. So nobody else needs to know that I applied for a loan and got it. I don't need to ask family or friends or the rest of the members in my SACCO or in my self-help group, etc. So those were again very encouraging learnings. And then the most important piece was really, will the numbers work, right? These are loans, and for the last many years, on average, the portfolio has been anywhere between sort of the late 20s, late 30s dollar loans, right? So on average, kind of 27, 28 to 38, $39 loans, and it varies by the year. But that's really a fraction, an order of magnitude smaller than the average bank loan in these markets before we launched this portfolio. And so really, could we make the unit economics work? Would we get to a point where customers are willing to pay for this, banks are willing to set a price point that makes sense? And there's still a lot of work to do to bring these costs down and bring the price point down. But we realize that we're at a point where the players are coming together, the market is working, and there's now our work is really cut out to bring prices down and to bring costs down. But I think that the key takeaway beyond all of that was that within this current model, where we partnered selectively with one or two banks in a given market, we created a model where the entry barriers are tremendous. And what that meant was that we're really creating monopolies. And we had sort of the first bank that we launched a partnership with became the largest retail bank in East Africa on the back of that partnership. And we realized we weren't technically and, sort of in terms of manpower, able to scale and open up that opportunity to other banks in the market. And so we needed to take a step back and relook at what this meant, right? And, again, in 2021, this sounds extremely obvious, but just a few years ago, it wasn't quite clear which way to head in. And of course, we knew one thing, and that was that handing over data to one or two partners was not the way to scale. So what we did was we built a marketplace. And I've just framed this for you in the terms that Peter's used, so that it's sort of familiar in terms of the context. So what we've done is really built out a product layer, and Phil and your team, I wish you operated in the markets that we're in. But unfortunately, we've spent a lot of time having to build that out. But really, what you see in the center there is this product layer. So we've built out a range of generic products that can then be customized with each bank partner for short-term consumer loans, short-term merchant loans, so at the till-based, point-of-sale-based repayment possibilities, overdrafts for both consumers, merchants, and agents, device finance, sort of the ability to buy a handset, but then that's again can be extended out to other types of devices, and pay later or buy now, pay later. And then lots more to come, but this is the first sort of suite that we started with. And all of those are really powered by a set of capabilities that we've worked on to expose. So rather than obviously handing over data, we've built out a credit score that we've worked closely with FICO on using our data. We've built out a set of customizable decision engines, so customizable rules and pricing rules. So you can set your price, you can set your credit strategy on the basis of underlying data across a whole range of parameters, like over 50. And a loan management system for banks that didn't want to use their core banking platforms to manage this portfolio, a number of reports, and then collection tools. So the ability to send reminders and use other sort of points of escalation to manage that portfolio. So having created that sort of set of capabilities, we then went out to a number of banks, and the ones you see on the screen are some of our initial partners, so Maza Banco, Kenya Commercial Bank, Access Bank, and EcoBank. But we're working with many, many more in the process of coming on board. And the idea is really to enable those banks to launch a range of products, a version of anything that you see on there or anything else that they believe is relevant for any of our active customers, merchants, agents, large businesses wanting to service their supply chain partners better, or even the developer community, for example, in that kind of concentric circles of who we engage is broadening. And I think, as Peter mentioned, there's a distribution layer that really is our original and kind of core strength, which is that agent network, the ability to engage customers. In most of the markets we operate in, we tend to be one of the largest campaign managers as a brand. So both above the line, below the line, we run a lot of customer engagement campaigns, financial education campaigns, and that's a channel to attract people through, and then using the existing interfaces that they already have access to for their core mobile money service or M-Pesa service, like USSD, SDK, the app, of course, and then the agent network. But I think what's key, and both Phil and Peter talked a bit about embedding products, and I think really where we see this going is the products that we see scaling are very much those that are embedded within existing transaction journeys, like an overdraft or like buy now, pay later, etc. And so, interestingly, before the pandemic, our core portfolio was sort of over 70% short-term personal credit, and in the last sort of 18 months, that's swayed heavily over to overdraft. So going from an average loan size of kind of $35, $36 down to $3 to $4, but taken a lot more frequently. And that's anyway, interesting sidebar. But really, that's what we've built, and very, very keen to talk more about where this is going next and implications. But we'll stop there.
Thanks, Devyani, so much for that. Really fascinating insight into the direction that you guys are going, and it's easy to see that it's early days, but also to see the enormous potential that lies here, both for you and for financial inclusion. I think that potential has already started to be realized in Asia with the rise of super apps that create these vast digital ecosystems that already embed a range of financial services. And I think no company embodies that more than Grab does. So I'm very pleased to invite now Chai-Pui San, who's Director of Public Affairs and Policy at Grab, to share a bit about how and why Grab is moving so deeply into financial services.
Thanks so much, Peter. And very good afternoon or good morning or good evening to everyone on the call, depending on where you're calling in from. I've shared my slides, if you can see it. Okay, so I'm Pui San, I'm from Grab, and I also serve as the Regional Public Affairs Lead for Grab Financial Group. And I'm super excited to be here this evening to share with you how we got here and what we've done so far and what's the exciting things that you can look forward to from Grab Financial Group. If for those who are not familiar and haven't been to Southeast Asia, you may not be aware of Grab. We are the Everyday Everything super app for Southeast Asia. We started, interestingly, in the ride-hail business, not in financial services. Oops. And after following that, we actually expanded our operations into food delivery before we ended up here in financial services. Interestingly, how did we start here? We started because our co-founder Ling had difficulty getting a safe ride in Malaysia, taking a taxi. And that's how Grab started as Grab Taxi. Subsequently, now we are known for not just ride-hailing, but food delivery as well as financial services. And what's our secret sauce here? Our secret sauce here is our super app that enables our users to access our services and the Grab ecosystem. In our mind, it drives a virtual flywheel of ecosystem engagement. Simply put, as consumers spend more with different services on the platform, it also generates income opportunities for the gig workers, the drivers, and the delivery partners on the platform. And then with more engaged consumers and drivers, this then provides a springboard for us to launch and introduce new services to the consumers through the app. And this could then lead to opportunities in financial services. But how did we get here in the first place and decide that financial services is the area that we want to focus our time on? When we first started in ride-hailing, we had to help a lot of our drivers set up their first bank accounts. We also had to work to help them settle their leasing arrangements with financial institutions. We also then had to help them find insurance to help them with their jobs as they drive with Grab. And so we started to ask ourselves, why isn't Grab doing this work? Because the banks aren't doing it, and we are having to help them ourselves. And this is the start of Grab Financial Group in 2018. We started with Grab Pay, which is an e-payment wallet that's popular across Southeast Asia. And now we are into insurance, lending, wealth management that supports both our consumers as well as our driver and delivery partners. And the mission here for us is really, we ask ourselves every day, how do we drive financial inclusion for the underserved in Southeast Asia? And how do we make it relevant and accessible to the middle economy and power Southeast Asia's growth? Who are our primary customers? We serve mainly three groups: young white-collar workers who grew up in a very mobile-first world and expect financial services to be instant, easy, and to use and understand. We also support our driver partners who have very limited credit history and need help to protect their families. The last group we serve is SMEs who need credit to grow their business. And traditionally, we've found that they found it very hard to access financial services. They find it inaccessible when financial services are mainly designed for the top 10 to 15% of the population in Southeast Asia. They find that the services are complex, hard to understand, lots of jargon, lots of fine print, and they are afraid that they are expensive and have hidden fees. And this is really the untapped opportunity here that we're trying to tackle here at the Grab Financial Group. Southeast Asia to us is an area with a massive opportunity. We have 6 in 10 of Southeast Asians who are underbanked. 9 out of 10 of Southeast Asians don't have a credit card. The digital financial services industry is still very young. There's lots of headroom for growth here. And to succeed, we believe that we need to take a different approach from incumbent banks. Our approach is to use our platform and our ecosystem to make sure our services are accessible. We can fractionalize products to drive down costs. We can make it very convenient for people to sign up, and we can make sure the services are transparent and easy to use. And so how are we reimagining the financial system in Southeast Asia? We are embedding financial services into our integrated e-commerce system. How are we doing so? With the buyers or consumers, we really started with payments, helping them pay with QR codes or even a GrabPay MasterCard. Now we're moving into buy now, pay later solutions. We also provide our consumers with lending, insurance, and investment products. On the seller side, with merchants, we also are helping them power their business growth. With tools to help them accept payments, we help grow on and build online web stores for them to help them go online. We help them with loans, and we help them to grow their digital footprint through the Grab Super App. And for us, the ability to connect both ecosystems together puts us in a very powerful position to drive a virtuous e-commerce flywheel where we have more buyers, attracting more sellers, and then bring more buyers to buy more products on the platform, and so on. And the more data we get from these transactions, it allows us to tailor more attractive financial services to help this group of people. So if I can just go through some quick stories about who we've helped since 2018. As you know, Southeast Asia is mainly an offline economy. It's very largely cash-based. When COVID hit, we helped merchants like Jessica from Malaysia, who runs a spice market store. We helped her set up an online store. We helped her put in GrabPay into her business and help with deliveries as well. And another example is how we help merchants with cash loans. In Thailand, we've helped give cash loans to merchants on the GrabFood platform because we understand what is their transaction profile on the platform, we understand what kind of business they run, and we're comfortable giving them credit. Oops. Oh no, sorry. Which one is it? Here, yeah. Another interesting thing that we're working on is scenario-based insurance. Our portfolio mainly comprises innovative micro-insurance policies, where we fractionalize insurance around scenarios such as ride-hail, around the ride-hail experience, food delivery, parcel delivery, as well as health. And this is something that is designed for us to roll out at scale. So in the last 2 years, we've sold over 130 million micro-insurance transactions on Grab, and this shows us that there's real demand for such services. I'll give you one example. In 2018, we also launched a critical illness plan for our drivers in Singapore, where they can pay between 10 cents to 50 cents per ride that they do to accumulate insurance coverage for their critical illness insurance plans. And I think 7 minutes to go. I'm going to end here with an exciting update. Peter, I know you said that you think that platforms like Grab should stay on the consumer end. But we are actually building a digital bank in Singapore. We are extremely lucky to be one of the license holders who have been awarded the ability to build a digital bank in Singapore. And we're doing that with a joint venture partner, Singtel, which is a local telecommunication company. We've also put in an application for a digital bank in Malaysia, and we're waiting for the results. So this is going to be a very exciting time for Grab as we expand into the digital banking space. There are lots to learn, and I'm really excited. And I would end off to say that the opportunity in Southeast Asia is immense, and the mission to serve the financially underserved in Southeast Asia is huge. So from Grab's perspective, we're just getting started, and we can't wait to continue doing what we've done and share more with the group as we get more things done in the region. Thank you very much.
Thank you so much for that. It's great to hear what you guys are doing, and I think that some of the numbers you shared sort of say it all. 130 million insurance policies sold to low-income users. The ticket sizes, all of it really speaks to microfinance products, and it speaks to the scale that is possible with this. And they are truly embedded products. I would encourage everyone to go look closer at the insurance cover, for instance, the ride cover that is activated automatically. As soon as a driver gets a ride, as soon as a rider gets on the bike or in the car, it's activated. You can toggle it on and off with a switch in the app and so forth. It's a wonderful example of embedded financial services. We haven't had a lot of questions come in from the audience, surprisingly. Maybe everyone is still taking this in and digesting. So we're going to wrap up with a question from me to the panelists, one in turn. And I think I want to focus on the potential risks that are coming out of this. We see the opportunity, we see where you're going, we see where you're headed. But what can be harder to get a sense of is what the main new risks are that this will throw up for consumers, for incumbents, for regulators, and indeed for yourselves as well. So I wanted to close up by asking you each in turn to speak very briefly, just a minute or two, to that question, and maybe we'll go in the reverse order that we started. So I'll ask Prisan to come back on, then Devyani, and then Phil, and then we'll close out. So Prisan, how do you think about the risks that embedded finance might bring over the course of the next few years as the service and this type of solution becomes more prevalent? What are the conversations that you're having with regulators and so forth?
I'll answer broadly, not just from a regulatory perspective, but maybe from a public perspective. To me, there are three big things. One of it is that while we understand that embedded finance will drive financial inclusion, we are very careful about thinking about how do we still bridge the digital divide in Southeast Asia. Many Southeast Asians are still not very confident coming online, especially the older groups or groups of people who have difficulty accessing the ability to own a mobile phone. So this is something that we think that's important for us to have partnerships with the governments to drive a lot more digital adoption. Financial inclusion is another area where we think it's still lots of room to grow in terms of driving awareness of the understanding of financial products that just isn't there, because some of these groups of people we're reaching out to have never had much of an experience with financial products in the first place. So that to us is one big area. The second one for me, and I think everyone would agree, is data privacy, data protection. This to me is a hygiene factor that we are very cognizant at Grab that it's a basic hygiene factor. We have to constantly plug at making sure that we have got our data privacy governance and our data privacy posture right. But going forward, one of the emerging things, if you think maybe 10 years from now, will be around questions around AI governance. How do we make sure that the loans, the algorithms that are giving out the loans, making the assessments, the data that we're bringing in, the data is rigorous, it's accurate, the algorithms are not biased. To us, this is an area that lots of regulators are looking at, and it's a great area of partnership and discussion going forward. The third area, it's a bit more of a far out one. For us, we know that digital embedded finance, digital interactions drive lots of scale. But as we do more and more of that, it's quite critical for us to keep thinking about where do we bring that sense of empathy, the human touch into the service again. Because we want to make sure that our services still remain very human-centered, still very empathetic. It drives interesting experiences for people. And that's something that we feel we have to be consciously thinking about that as we think through our customer experience. So for me, I think these three areas.
Wonderful, very clear. Thank you so much for that. Makes a lot of sense. Devyani, how do you guys see it at M-Pesa?
I love the framing that Prisan used, so I'll just build on that. Maybe the first category, fully agree with everything she said around the digital divide and the need for financial literacy. And I think in the markets we operate in, there's another element to that, and that's sort of digital confidence building, and really making sure that people can come online. So whilst we're a digital financial service provider with 50 million active users, actually less than 5% of that base actively use an app, right? Which is the channel that most people around the world would expect to have a digital service on. And so really building that sort of digital confidence as we go through, and that really links in with Prisan, what you said on the user experience, and ensuring that kind of customer centricity as we build that out, and ensuring there's the ability to keep that cross between the physical and digital until we get to the point of digital confidence. And if we don't invest there, I think we're not going to really reap the rewards that were promised here today. So that's a big one. Absolutely, again, agree on data privacy and where that's going, and consent management is a big area that we're looking at, and that regulators are certainly looking at as well, and an area that I think we have eyes on in terms of how that's evolving, and how we can support the regulators as well on ensuring that there's a level playing field for everyone involved. And I think the last area is related to what you said on the governance of the models, but we're already seeing specific to, I guess, to invest in what I mentioned in terms of what we're doing with the marketplace approach. We're seeing in China already the crackdown on Alipay and WeChat Pay and others, where there's a requirement now for each of the platforms to underwrite 30% of the portfolio. So there's they're not creating systemic risk by recommending or putting these algorithms out there and suggesting that other underwriters take on the risk that they're not taking on themselves, right? So that's certainly a natural evolution of where this model is going, and that's something that I think regulators and us as a player are seeing and keeping an eye out on. And I think finally, I guess there's a risk that regulators in our markets are not perhaps keeping up with where this is headed, and very practically challenges like cloud and data sovereignty and cloud hosting, etc. If you have to host locally, then we undo the promise of everything we're talking about here. So.
Thanks very much. And on that last point, we're definitely trying to do our bit to keep regulators up to speed, or emerging market regulators up to speed with what's happening and the questions they should be asking themselves and the providers in their markets. We hope that we have some of them with us today in the audience. We hope that other audience participants will share this with regulators in their networks and so forth, because it's important to get that conversation going. Let's wrap up with Phil and see. We got 3 points from Prisan, 3 points from Devyani. Let's see if we got another 3 from Phil as we close out.
Yeah, I've got 3. It's transparency, transparency, and transparency, right? I mean, I think that's key to our success, right? Starting with the consumer, right? You want to make sure that the consumer understands the products they're getting. They understand the system. Now, they don't need to know all the players, but they have to feel safe about using it. And so they need to understand and be transparent. You have to be transparent with your partners, right? As the bank, they need to know when they enter a relationship with a regulated financial institution, they need to know what to expect. And so being transparent with your partners ensures long-lasting relationships. And obviously, the goal is to evolve with your technology partners. As they continue to unbundle the services and look for more verticals to offer their customers, we want to make sure we're keeping up. And then finally, as was said masterfully by my partners, transparency with your regulators, right? Over communicate what you're doing, how you're doing it, how you're ultimately serving the communities that you're trying to serve, and providing access to financial services is key. We can, sort of at Cross River talk about all the great things, but if we're not talking about it to our regulators, we're going to hit hurdles and roadblocks. And so transparency is key throughout the ecosystem.
Wonderful advice from all of you there. And with that, I'm afraid our time is coming to an end. I want to thank everyone so much for joining in. I hope you enjoyed the conversation. This has been just a taste of what Seagap has written on the future of financial services and inclusion. We have a new publication out today on unbundling that gets into all of this stuff in much greater detail. So head on over to seagap.org/fintech and check that out. Thank you so much to CFI for organizing Financial Inclusion Week and letting us host the session. And above all, a huge round of thanks and applause for each of our three panelists, Devyani, Phil, and Puisan. Thank you so much all for joining. We hope to see you soon.